Hi, this is JP Newman on Investing on Purpose, and today we're going to change it up a little bit. We're going to talk about what actually makes a good real estate deal. We've talked a lot about the why and purpose, but of course, if you don't have the structure and know what to look for, and by the way, it changes. As the market changes, what a good deal changes. And I find that a lot of people will sell you on certain maybe stale ideas of what a good deal is for real estate. Today, we're going to take a deep dive with my partner, Adrian, and we're going to talk about what is a good deal now. What are the opportunities you can look at now? Whether you want to be, enter into the real estate market or just be a great investor. What are the questions you should be asking? Diligence you should be doing, whether you're investing your money with other people or jumping in. I think you're really going to enjoy this show. As always, we love your feedback and questions, and we're going to continue doing this on a monthly basis. The market's changing. We see great opportunities, and for you to have the knowledge and the information and the empowerment to make good decisions to create, and sustain and grow your wealth is what this is all about. I hope you enjoy it.
Hi, everybody. Adrian.
And JP.
And we're going to talk a little bit about a deal. What is a deal? What's a good deal?
Yeah. Well, Adrian,
I don't know.
Well, Adrian, it's funny you should say that. We just got back from San Diego. This was the National Multifamily Housing Conference. This is when it's the biggest conference, annual, biggest one probably in the world, where everyone comes to talk about their deals.
And there's operators, lenders, investors.
5,000 people in suits, and they're hustling and bustling. So Adrian, I'd love to get your takeaway, because I think this will segue into what is a deal and what was a deal and what is a deal now. I have to tell you something funny, Adrian. I came away hearing many, many meetings from bankers, joint ventures. And the nice thing is everybody was very optimistic about 2024. Now, I think there's a little liar's poker going on in there. I think there's a little over-optimism going on there. But it was good to see that. I do believe what's interesting about this cycle, there's lots of capital and lots of eager people who still believe that multifamily is going to be one of the strongest asset classes. And I think that's a very viable
thing,
right?
100%.
So where do you think, I know where I think the liar's poker was. Where do you think the liar's poker was?
I think it's still early.
It's a little early, right?
It's a little early.
Yeah.
Because we don't have enough distress that really took over the market to affect the market.
Right.
It's coming. But I think there's still too many lenders and borrowers hoping and praying that the Fed will save them.
And praying and spray is that's not a strategy?
Praying is good. It's good. It generally takes a little longer than that.
And Adrian, let's go back and segue. I always say people forget that commercial real estate investing is just a business. So you've got revenue and expense, and your goal is that you've got cash flow and profit afterwards. I think just to remind you guys, when your property insurance, your taxes, and your interest rates all go up at the same time, it's really challenging revenue on buildings that have been bought in the last 36 months.
Everything.
So I think what I hear you say, Adrian, is you're hearing everyone saying, when you say the distress isn't quite out there yet, it's like people bought these buildings, they bought them on high interest rates, they're feeling the pain, they're making their cash calls, or they're trying to make their cash calls, but the banks haven't quite seen how much pain, because a lot of these buildings, their revenue minus expenses is creating negative cash flow. And I think what you're saying is that pain has not quite been expressed yet in the marketplace.
And I think lenders are still unsure. They're juggling a little bit. Which ones do we foreclose on? Which borrowers do we work with? Which ones do we not work with? The real problem is there are many deals that we've seen as of late where the property isn't worth the debt that is on it.
Right.
So all of the equity should be wiped out, and some of the loan. That's what happens when cap rates go from 3.5 to 5.5. And we're not sure 5.5 is where they're going to settle.
Right. And remember, so I'm going to go back to the original question you started out with. So what is a deal? The reason why that's not a deal simply is you can't create cash flow. Because if your interest rate, for instance, right now is 6, and your cap rate, we won't whiteboard this today for you. But the point is, if your cap rate is at a lower number than your interest rate, it's impossible to create cash flow for investors. So everyone right now, part of the liar's poker, I noticed, Adrian, was that people are talking about everything now because things are on sale.
Yeah.
There's a sales rack now. Finally, there's a sales rack. And they say it's a basis play. Hey, you're buying it for 60% of what it costs to make it, which sounds great. And that is good. Especially if you think that multifamily real estate will be valuable down the line. then that actually is good. But Adrian, why is that not ideal now? If a basis play is good and we're already seeing discounts of 20, 30%, then why isn't it a deal?
I guess if you could buy it all cash, it would look a lot different.
It would.
But when you're again borrowing at 6.5, it this negative spread.
Right. So you're basically prospecting for the future value that one day it'll
Correct.
go up again, but you can't produce cash
And
flow in your business today.
you and I both agree real estate will be worth more in the future than it's worth today.
Absolutely.
But it goes back to timing. Where are we in a cycle? When to get aggressive? When to be patient? We didn't buy for a year and a half because we didn't believe those numbers. That we thought it's too expensive.
Right.
And so you can look really smart or smarter by buying a really ugly property at the right time than if you were to buy a beautiful property in a great location at the wrong time.
Right.
Because it's your basis. It could be pork bellies, it could be oil, it could be real estate, it could be Bitcoin. If you buy at highs, you need to sell higher. And if the market goes the other way, you're underwater.
You've been a trader for years, so you really
It's not
you
much
understand
more
this.
difficult than that.
Okay, Adrian. So my big question to you is now a good time to invest in apartment, multifamily real estate, or real estate at all?
Definitely, maybe.
Excellent. Tell me more.
And a lot depends on the individual, your risk parameters. What are you willing to risk? What's your timeline? A lot of people get in investments for short term, and if it doesn't work, they make it a long term or reverse. And so you have to have kind of a premise of what you want to do. You and I have been very fortunate that we bought really well early in last cycle, and we wanted to hold 5+ years, but we got these crazy offers in year 2, 3,
Right.
and we couldn't turn it off back. We just said, okay, we didn't expect that price. Understanding your premise and what's comfortable to you is so important in investing. You and I are very similar in a lot of ways, and a lot of investments, we look at them totally different.
Yeah, it's
Because
true.
our comfort is different.
True.
And depending on what the asset is, the longevity, does it have cash flow? There's some investments where you're going to get a huge upside, but there's no cash flow. Or there's some with a little lower back end, but you get cash flow from day one. So you got to understand that Warren Buffett, who's been around a long time and is kind of successful,
Yeah.
always said he loves buying when everyone is panicked and he loves selling when everyone is euphoric.
Yeah.
And it's very counterintuitive to emotion when we call them the go-go days, when we were in the thick of it and people kept sending us stuff to look at, to invest. And we were like, I don't like that deal. And yet tons of people were doing it because it looked great on paper, right? It was a 20+ return. Oh, you fix up the unit, you charge more rent, and then you turn around and sell it until you don't. And so understanding your own comfort and parameters is really important.
Yeah, I have a huge emphasis. I tend to be a little more conservative, as you know. And so for me, like these days, like I think for most people, unless you have a net worth of over 25, $50 million and you're saying, you know what, I just don't need the money for 10 years. I think you can throw it, like for instance, right now, I'll give you a secret. You ready for a secret that's
I'm
gonna make
ready.
you
Give
millions
it
of
to me.
dollars? Millions of dollars. You could buy anything in Austin, Texas today at any price, and in 10 years it'll be worth more. I just gave you a multi-million-dollar secret.
Yeah.
Thank you very much. But the problem is in between. What's your tolerance in between? I like to cash stack. So for me now, more than ever, Adrian, I'm trying to resist. So many things are coming at me, but if they don't have cash flow within 12 months, I'm not doing them right now because I'm saving my cash because I believe there'll be some better real estate opportunities. I think for most of you out there, you should be thinking about cash flow stacking right now and not doing. And if you don't see cash almost right away, I would hold off because I think a lot of equities are overpriced.
Well, and you say that geared towards a lot of people that don't have that net worth, where if they invest $1 million and it doesn't work out for the time being, but they can hold it for 8-10 years
yeah,
and their life doesn't change, that's a different model than what most people are dealing with.
right.
And so I think it's not one investor is all the same. I think people really need to think about what they're comfortable with.
Yeah. But Adrian, even you're saying right now, you and I have done so many investments
We
together.
have.
And how liquid are a lot of our investments? Oh, it's 3 years out. We have one investment together, Adrian, where we haven't even seen an update in about 2 years. And we're supposed to be in the hottest tech companies all around, like the hottest tech companies. And yet that money has now been, that money, if it's still around, we'll see. If it's still even there, haven't had an update on it. But yet the biggest companies on the planet we got invested in. We should be multi 10xing our investment, but it could take 10 years. Was it worth it for my time? But we'll see.
We'll see.
We'll see.
And you know, the good thing is, JP, our lives won't change.
Because we put an amount in that we were willing to put in that.
And I think as an investor, people are different from a risk perspective and a nerves perspective. And we don't want to expect the worst, but it can be. That's why it's an investment. If you don't want the risk, you buy a CD at the bank, you make your 5.25% and renew it every year. And that's just because rates are good today.
Right.
Normally, it's less than 1% when rates go down. So it's understanding there's a bucket for a little risk, a little more risk, and then a smaller bucket for high risk.
Right.
And if that's what makes you comfortable, great. And if not, don't even entertain that. We have experienced some returns in multifamily that are not normal. We've seen 30, 40, 50 IRRs, right?
Higher.
And that's not typically normal. And we've spoiled ourselves because if we were to get 12 to 15, it's a pretty solid return.
I agree.
With cash flow and appreciation.
Well, now we have to have new conversations with investors. We just got out of the funnest party of the last 11 years, and now we have to kind of re-educate.
And we'll start a new one, but everything will be adjusted, and it'll take time to rebuild.
Hey, I hope you're enjoying the show. And if you are, just know a lot of this content comes from my day job at thrivefp.com that underwrites this entire show. If you're interested in learning more about purpose-driven investment opportunities where success and sustainability and purpose come together, check out thrivefp.com. Now back to the show. So here's our play, guys. So we could tell you what a deal was, which our producer wants us to do, Alex. But before we tell you what a deal used to be, what a deal looks like now, I think, Adrian, if I'm going to look like 6 to 12 months out in the future, basis is great. Prices, and you both and I both think that prices will go down more, lots of capital that I don't think we're calling blood on the streets, but we will see more distress. I think what you and I want to see is there'll be people crowding at the well to take advantage of that distress. So the prices may not go down as much as we'd love to see. But I think our thought is that I bet you if we work really hard, we can pick off 1 to 3 deals where maybe like the lender didn't market it right and it was 100% loss or a 90% loss. And we can actually pick it up not only at a good basis, but at a basis where within a short period of time, we can create cash flow, right? Because most of you out there, when you're looking at real estate investments, should be asking not only what do I think it's going to be worth in the future, which, by the way, only that Microsoft Excel and ChatGPT can tell you right now, and they don't even know.
Yeah.
So at the end of the day, if you really don't know what a sale price might look like in 3, 5, or 7 years from now, then I would really want to know what that cash flow. Can I rely on a steady set of cash flow on it? And I think that's really important. I think right now we're not there. I think if we're lucky, Adrian, 1 to 3 buildings this year where we actually heads we win. Remember you said
we don't lose.
Tails we don't lose because it's a good basis. And we can produce reliable cash flow. We believe without having to do add a 5th story or add a moonwalker or add
we
like
know
a 19.
Rents aren't going up right now.
Right.
And we know that expenses aren't coming down.
Right.
That's 2 really big negatives because there's no way to create more revenue that way.
Right.
But what we do know, if you buy it well and you can operate it well, we don't need to operate it or think about 10 years. It's really about 1 year to 2 years. If you buy it well, we do believe in 12 months, rates will be lower than
Did you
today.
see 60 Minutes? Jerome Powell's talking about interest. Everyone's assuming that interest rates will go down.
How much? We don't know.
We don't know.
If we go down a little bit, values go up a little bit.
Well, there's also another thing. We've had so much supply delivered on the market, and that supply is drying up.
That's another whammy.
So back to rents. One of the reasons why the rents are soft is because we've had so many new apartment units being delivered. So as your point is, there's been a lot of the commodity. As that dries up because now people aren't building, you're going to get this double whammy of lower interest rates, supply lowering, which should actually create, again, once again, a reason for
Yes.
values to increase. So it takes a little courage right now.
It
In
is.
2024,
Yes.
it takes a little courage to buy because you are going to buy in basis and forward looking out.
And no one's going to buy the bottom or tell you this is the bottom.
No.
You don't get the memo. It's you're around it. And when you look at something with risk, if you're buying a market at highs,
Yeah.
you're taking a lot of risk. If you're buying it somewhere in the middle or closer to the lows, you have a lot less risk
Yeah.
and you have a lot more upside potential. And that's kind of where we are. We don't know, is this it? Is it, oh my gosh, it's the bottom.
But I think right now we feel safely. You and I feel good enough
Much
that
safer now than we did last
we
year.
will find our deals. Okay, Adrian, I have a liar's poker story to tell you. What's my favorite story from, besides you and I having a great dinner? Two economic indicators that tell me where things are at. There's a famous dinner that we go to every year. And I always say, depending on what quality of tequila they're pouring tells you the state of the real estate economy.
It was good quality.
Right. So the fact that this company, they were still, you were taking advantage of this in a
Oh,
good way
yeah.
and sharing with
I
me.
was doing my part.
So we noticed it was a very high degree of tequila. It's kind of probably like Groundhog Day. It's like looking at the groundhog and assuming. I think the tequila pouring is one serious economic indicator we have to look at, right?
Yes.
I think the second one, the liar's poker, there was a person I met with who was telling me, gosh, things are just great. I just acquired thousands of new units and I've got this property management company. I said, how many employees do you have right now? He goes, oh, I've got over 100 employees, bought an X amount of units and on and on and on. I said, are you making money? He goes, well, not yet, but I will be next year. And I thought that was just great. Because
Wow.
if he didn't ask the second question, you'd be like, oh my God, this guy's finding deals.
Yeah.
What?
Not
He's
so
still
sure
betting on the company
if he makes it
if he makes it.
to next year.
And I wish the best for everyone.
Yes. Yeah. Again, we need the markets to help us. We're really good at finding and operating deals. And we've always done well. When the market goes against you, you can be the best in the world. It doesn't matter. And so we need a lot of things to be in alignment with us. Debt is one of them.
Yeah.
We don't have the luxury of being able to buy 4 or 5 $50 to $70 million deals all cash. We don't. That's not how we raise capital. Big institutions might be.
I think they'll lean in first with that. I think you're gonna see the big institutions who don't need cash flow, who can just muscle it out. They're gonna win the first ones.
We do know deals look a lot better today than they did 6 months ago.
No, I'm telling you, I'm feeling it. I'm feeling
We
it's
made our
coming.
first 2 offers,
I know.
right?
Yeah.
And they were more than 50% lower than where they were actually built. So we're getting there, and the pain has to be uncomfortable enough for borrowers and lenders to really jumpstart the market. And I think we're close. The good thing is the fundamentals are still there.
Oh yeah.
Our
buildings, look at most of our buildings are over 90% occupancy right now.
and that I always have said that oversupply is worse than high interest rates.
Yes.
Because oversupply, you lose all pricing power. We know that absorption will happen over 12 months. And it just so happens that Houston, Dallas, San Antonio, Austin are some of the busiest markets according to deliveries.
Yes.
So it gets a little bumpy. And being able to manage through that till everything gets absorbed is the secret sauce.
Yeah.
Once it's absorbed
but prices will be up. You got to do it now. This is where it takes a little cojones to actually go do it. Okay, Adrian, last thing, because we don't want to keep, the details will be coming. We'll continue. I have an idea. What if we start putting out there that people can ask us questions as investors of what they actually want to hear from us, how we can give them advice? Because I feel like every day your phone's ringing, my phone's ringing, people are asking all kinds of questions and concerns. So I'm going to have Alex. Alex is going to get a Thrive FP email address. Alex at Thrive FP, ALEX at ThriveFP.com. And you can ask your questions to Alex of questions you want us to address on camera. I think
I
that'd
think
be
it's a
super
great
fun.
idea.
Let's do it. That's all I got for now.
Thank you.
Peace out.